Now, before we break and recharge, we have our signature segment, which is called the One Takeaway Challenge. If you were here last year, you would have seen it. We're bringing it back again this year. It's very exciting. It's a little bit like financial speed dating. And this is where we invite 4 distinguished experts to share what they think are the best themes for 2025. So it's called Best Themes for 2025, Searching for the Next Opportunities. The thing is, they only have 1 minute each to convince you of their views or at least leave an impression on you. So if our participants are ready, I would like to invite our first participant, Richard Chan, Vice President, Brookfield Oaktree Wealth Solutions. Please welcome Richard. Yes, so time will start as soon as you start talking. 1 minute sharp.
Okay, private credit today is yielding 10%. This is very important, so I repeat. Private credit today yields 10%. Now, what does that mean in credit? In credit, 10% means if you do your homework right, and company, most of them, pay you on time, then investors are going to realize a return of about 10%. At Oaktree, we've had a long history of doing our homework right. For example, our default rate is as low as 0.4%, and our actual loss rate is only 0.1%. That is 10 cents on every $100 invested. So on a portfolio yielding 10% now, we're comfortable to deliver 10% return. Now, if an investor is looking for 20% return, then we might have a problem, and I suggest they talk to the hedge fund experts or crypto experts. But here's the takeaway. Oaktree Private Credit yields 10%, and is it enough for you? Thank you.
Very good. Thank you, Richard. Under the 1 minute deadline as well. What was the message? Private credit yields 10%. Good. Well done. Okay, our next participant is Sam Gillespie, who's Regional Director from Dimensional Fund Advisors. Please give a warm welcome to Sam.
So as investment professionals, we all love a good story, so let me tell you a story. The chart you can see behind me is the annual returns of 23 developed countries going back to 2005. Now, these countries paint a picture and a story of global returns. The returns showed up here envelop Trump, tariffs, everything in between. And the reality is that when we look at the returns, we never know what we're going to get. Going back through time, if we look at building out a portfolio and focusing on various returns, the various markets have returned, on average, an 8% return since 2005. And while we may direct our attention to all the various noise and different places we could direct that capital, we feel that tuning out the noise and investing in a globally diversified portfolio is very much not cliche. It is one which will help you to achieve your goals through time.
Very good. They're actually getting shorter. 50 seconds there for Sam. Thank you very much, Sam. All right, our next participant is Neil Johnson. Neil is Managing Director at Macquarie Asset Management. So please welcome Neil.
For the past 30 years, Macquarie has been a global leader in the infrastructure space. Today, I'm going to explain to you why we believe that infrastructure has an important role to play in a diversified investment portfolio. Infrastructure is essentially defined as essential services and facilities, from wastewater and water treatment to airports to data centers and fiber networks. As an investment class, infrastructure's got a number of very attractive characteristics. It provides strong risk-adjusted returns backed by strong cash yield. It has low correlation to other asset classes, which can provide portfolio benefits. But as we've heard today, particularly in the current macro climate, there are 2 points I want to highlight. Infrastructure typically has inflation-linked revenue streams. Therefore, it can provide a productive hedge against inflation. And as essential services, it has strong downside protection and can outperform other asset classes in times of weak GDP growth. Thank you.
Good job, Neil. Thank you so much, Neil. Advocating for infrastructure there. And our last participant in the one takeaway challenge is Jingjing Huang, Senior Vice President and Product Strategist at PIMCO. Please give Jingjing a warm welcome.
Our takeaway for you today is to lock in high single-digit yield and potential return without taking high risk by simply investing in liquid, public, high-quality bond portfolio. There are three reasons. First, the correlation between the starting yield of a high-quality bond market and your forward return is as high as 94%. So where are we right now? That's the second point, the very elevated yield. Today, the global ag bond index yields close to 5%, and that's at the 10 years high level. An active manager like PIMCO can add additional alpha and deliver a yield above 7% in a globally diversified high-quality bond portfolio. And lastly, the nature of very stable, high-quality bonds can give you the margin of safety, which is particularly important in today's market. Thank you.
Well done. Thank you, Jingjing.